Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what companies are really doing behind all the jargon. Today, we're diving into Park Ohio Holdings' latest annual report, a report that's about as exciting as watching paint dry, unless you know what to look for. So let's see if we can find a hidden gem or two in this document. Park Ohio, if you haven't heard of them, is like that quiet company in the background that makes stuff for everyone else. They handle supply chains, build capital equipment, and manufacture components, working with industries ranging from heavy-duty trucks to aerospace. But how did they really do last year? Let's find out. First, let's get a quick overview. Park Ohio reported net sales of about $1.66 billion for the year. That's a massive number, right? However, let's dig into how those sales break down. They operate through three main segments: Supply Technologies, which handles sourcing and supply chain management; Assembly Components, which makes parts mainly for the auto industry; Engineered Products, which builds heavy machinery and equipment. For the year, Supply Technologies brought in $775.8 million, Assembly Components made $398.7 million, and Engineered Products $481.7 million. Now, a significant change: they sold their aluminum products business in December. This impacts the numbers, so we'll need to keep that in mind as we go forward. Operating cash flow was a positive $35 million, but that's less than the $53.4 million the previous year, mainly because of higher working capital needs. If you look at their cash flows, they spent more than they brought in from operating activities. They spent over $30 million on capital expenditures, which are investments in things like equipment, and used $16 million to pay down debt. So they had to sell 550,981 shares of their own stock for $15.9 million under an ATM at the market program to cover the gap. Selling your stock isn't usually a sign of financial well-being. Now, let's talk about the segments in more detail. Supply Technologies, that big revenue generator, saw a sales increase of 1.6%. That bump was driven by strong demand in aerospace, defense, heavy-duty trucking, and consumer electronics. But they also took a hit from a decline in power sports and recreational equipment and agricultural equipment. Assembly Components, not so hot. Sales decreased 6.8% because of lower product pricing on some programs and lower unit volumes on end-of-life products. They tried to offset the losses with their profit enhancement initiatives. Not sure those worked that well, it seems. Engineered Products net sales were up almost 3% due to higher capital equipment and aftermarket sales. That's good, but their segment operating income was down a bit due to higher costs in their forged and machined products business. That's not what you want to see. Sales up but profits down means you're making less for every sale. So what about risks? Every annual report lays out the things that could go wrong. This one is no exception. Buckle up because there are a few big ones. First, their industries are cyclical, meaning they go up and down with the economy. Anything from consumer spending to international trade and tariffs can throw a wrench in the works. They are also worried about disruptions in the credit markets. Basically, if banks stop lending or charge too much interest, it'll be hard for them to grow or even maintain their business. Another huge risk they mention is dependence on key customers. If they lose even one of their major clients, it could really hurt their financial health. Like every company these days, they are worried about cybersecurity threats and breaches. A major hack could disrupt operations, lead to legal trouble, and damage their reputation. The company has spent time building security practices to mitigate this from happening. The VP of IT reports to the board yearly in order to keep in touch with what threats and risks are present to the business. The good news is that so far they haven't had any major cybersecurity incidents. Labor issues are another biggie. A significant portion of their employees are in labor unions, and strikes or work stoppages could seriously disrupt production and increase costs. Because they operate all over the world, Park Ohio is exposed to risks like currency fluctuations, political instability, and the Foreign Corrupt Practices Act, which prevents bribery. Staying on top of all those different rules is an enormous job. Environmental regulations are another headache. They have to comply with a bunch of laws about things like waste disposal, and failing to do so can lead to fines and lawsuits. This is really important to keep up with, so it's good that they mention it. Okay, so what does all this mean for Park Ohio? Well, they are facing some serious headwinds. Their strategy is to expand through targeted acquisitions. But there's no guarantee they will be successful at finding good companies to buy or integrating them properly. One last thing, the chairman and former president, both named Crawford, collectively own a large chunk of the company's stock, around 28%. That means they have a lot of control, which could be good or bad depending on whether their interests align with other shareholders. Let's get to my overall take. Park Ohio is a mixed bag right now. They have some solid revenue streams, particularly in their supply technology segment, where their long-term contracts provide stability. However, they're facing a lot of challenges. The auto industry, a major source of their revenue, is cyclical and undergoing massive change with the shift to electric vehicles. It is still unclear if the company will be able to adapt to these changes. Their debt is also a concern, and relying on short-term sales of stock to plug the gaps is not ideal. On the positive side, they seem to be taking cybersecurity and environmental compliance seriously, which is essential these days. Overall, Park Ohio is a company at a crossroads. If they can successfully navigate these risks, they could be a solid long-term investment. But if they stumble, things could get rough. Keep an eye on their debt levels, how they manage labor relations, and their ability to adapt to changing markets, especially in the auto industry. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate deep dives. Until next time, keep those critical thinking caps on.